Hello everyone, welcome back to my channel. So I know it's been a while since the last time I posted one of these videos, but there's been a lot going on over the past few weeks, and so I needed some time to put things back in order. And so in any case, I just want to say a huge thank you to everyone who reached out to me over the last few weeks and asking me what the reason was for not posting any more videos like this one. And so I must say your support has been amazing, and I'm extremely grateful to all of you. So thank you very much for being always keeping up with things and reaching out, and also because of your concern. And so in this video, we are going to talk about an event which was held by the CAIA Europe, Middle East, and Africa that recently took place on private markets. And this took place at Amsterdam Business School. I also reposted on my LinkedIn page and the page the post of the event on my LinkedIn page, and so I'm leaving the link in the description down below. So feel free to check it out as well. And so, by and large, the event was a series of presentations providing basically an update on the current situation on both the private debt and the private equity markets, along with some insights that can be gleaned from historical data on private markets. And so the first presentation was led by Professor Jens Martin, which is an assistant professor at the University of Amsterdam. And so according to the data he was able to gather, for most managers, it is, as you would expect, especially if you have already gone through the CFA program and also the CAIA. It's very difficult for managers to achieve persistent alpha, which basically means that persistent alpha is higher returns through active management than through passive management. And so this is, I would say, is also one of the reasons why passive funds are so popular, because on average they can get, as you could see, a comparable performance, but passive funds have on average lower fees and commissions paid by investors. And so it's normal that investors prefer not to have that sort of wedge between the performance of the fund and their performance into their pockets, so to speak, because of the fees and commissions. And so they would prefer passive funds rather than active ones. Nonetheless, another important reason for the difficulty in attaining those excess returns by managers is that as managers achieve those returns at a given point in time, investors tend to react by allocating more and more capital to those managers. And so, besides the obvious fact that additional capital to allocate by the manager, of course, entails a higher workload, which of course burdens the manager and its infrastructure, and also as a result affects his performance. We all know that the number of very profitable opportunities in private markets is usually limited. And so managers are usually forced, when they have so much more capital to allocate, they are forced to allocate some of that additional capital to less than optimal investments in order to avoid what they usually call in the industry as the cash drag, which means that the lack of return due to not allocating the capital to any investments, and so by keeping that capital in cash. And so by allocating a portion of their capital in less than optimal investments, they usually lead to lower overall performance and results by the manager. And so Professor Jens also pointed out the potential moral hazard that exists, I should say moral hazard or conflict of interests, that exists when managers manage several funds. They have several funds under their own remit and scope. And also when they both hold debt and equity on the same company. Why is this? Because managers may have a conflict of interest in which, because they have only very few very profitable opportunities, but they have several funds in which they should allocate these opportunities, they may be affected by some conflict of interest of any sort, perhaps because they know some investors for a longer period of time, or because their investors helped them the most to take advantage of several investments in the past, and so they may have a built-in conflict of interest that leads them to allocate their best investments or their best opportunities to some funds and to some investors, to the detriment of his other investors. When it comes to conflict of interests between debt holders and equity holders, I think it's quite easy to understand that, in a nutshell, debt holders prefer that the company management takes less risks with the business, because if they take more risk, the debt holders do not get any upside or any additional return from that more riskier behavior. And so if a company wants to take more risks to increase its profitability, debt holders see nothing or nothing more than simply the coupons and their capital back, and see no upside or have no share in that profitability. But on the other side, equity holders capture actually that entire upside potential, and so they have all the incentives to put pressure on the company management to take risks to increase the profitability. And so if you own equity and debt from the same company, which side are you going to take in? Are you going to try to persuade or put pressure on the company management to try to increase and take more risks to increase its profitability, or should rather take a safer route and try to keep it as safe as possible so that the debt still is able to be paid within the normal course of the business, and it does not there's no distress, I should say, no distress in the payments of debt due to the higher risks that were incurred by the company. And so this puts managers in a position in which they have to make a decision, or have to take an approach in which they might favor one party, but on the other hand, they may jeopardize the interests of the other party. However, in my view, it is quite clear that, and also this is also confirmed by Professor Jens Martin, is that on average, managers who are closely monitored by its limited partners or its investors tend to have better performance than managers who are not, if nothing else, because of course there is a pressure to perform. There is also the inability to do things less by the book by the managers on behalf of the managers if they are less closely monitored. So there are several factors that comes with it, but on average, this is what usually take place. I guess, So moving on to the next presentation, which is basically focused on private debt and was led by Mr. Rayane Cheniouni from the investment company Van Lanschot Kempen here in the Netherlands. And so in this particular presentation, it was shown that over the last, I would say, 10-15 years, commercial banks have been increasingly more reluctant to lend funds to smaller companies, as that entails incurring a level of risk that banks either are restricted to get exposed to in light of the current banking regulations, or because of the now high interest rate environment, they have lesser of an incentive to incur in risky investments to earn the returns they require for their business, which was not the case when interest rates were close to zero a few years ago. And so because of this more conservative approach by commercial banks, the supply of capital to smaller companies has been progressively replaced from being given or being provided by commercial banks to being provided by private debt lenders and private debt funds. And so as a result of this, the borrowers, corporate borrowers, smaller companies, have been turning to private debt lenders to get the funding they need for their operations. And so, because of this apparently change in the market, the private debt market has been growing significantly, and lenders have been able to take advantage of this lack, or at least former lack of supply of capital, by earning very, very rewarding interest rates for investors. They could charge more interest rates to borrowers because they had less of a competition in the market, and also because private debt funds and lenders were much fewer in the past. And so that's why they were able to charge much more interesting interest rates for them. And so this fact, and of course this historical background, this historical development, has been, I would say, a key factor for this asset class, private debt, to become more popular. However, at this stage, there are some banks who are starting to have a different look at the private debt market. And so, in particular, they now regard it as a potential opportunity for them to boost their returns. However, and this is also something that Mr. Rayane also shared with us, and it makes total sense, which is, as you can imagine now at this stage of maturity in the market, the private debt market has become much more competitive because there are much more private debt lenders. And so in recent years, it has become a much more difficult task for banks to re-enter this market and be able to earn the high returns that were once available. And so I would say that this happens with all investment products, and in this case it is no different. The so-called first mover advantage that usually brings higher returns to the ones who move first into a market. I think this, in this case, has already been captured by private debt lenders, because these lenders have basically taken over the market, which was being left out by commercial banks over the past few years. And so I would say in this regard, it is very difficult for commercial banks to get back into this market and be able to get the performance which was once commonplace in this market by the suppliers of capital. Yeah, basically, in terms of private debt, this is it. On to the presentation, the final presentation, which was focused on private equity, and it was led by Mr. Luke Kicken from the Partners Group. And so, based on this presentation and according to recent data, the level of activity on the market of mergers and acquisitions, which is known within the industry as the M&A market, the activity was quite lower in 2022 to 2023 relative to previous years. And so this lack of deals and lack of activity led to many limited partners, meaning the investors, many of those were forced to sell their stakes in private equity funds because they needed some liquidity. There were no exit opportunities available for them to exit their investments profitably, and so many of those decided to sell their stakes in private equity funds, and they sold them to third parties. And so sometimes even having a discount, selling them at a discount so they can get some liquidity. And so as a result of this, in the current state of the private equity market, Mr. Luke, and also it makes sense that he thinks that way, at this stage there are some potentially attractive opportunities for investors to pick up, as long as they can get a good points of entry into these stakes. And apparently, judging by the way the market is performing so far in early 2024, investors are also realizing this situation and are starting to get back into private equity positions. And so it looks like that, I would say in this year, the market is going to have a strong rebound in comparison, of course, with a much lower base that it comes from 2023, in which the activity in the M&A market was much, much lower. And so also one final point that is worth mentioning in this presentation is that, and I think this is quite an interesting one, which is over the past few years, only 22% of the companies that went public, going public meaning is that their stock becomes publicly traded. It's traded on an exchange instead of being privately held by a group of investors or a single investor. And so only 22% of the companies that have gone public have been profitable. And so most of them have come from private equity funds, which exited these investments, sold their stakes in an IPO to the public. And so why do I think this is an interesting development? It is because, by comparison, in previous decades, and Mr. Luke also points this out, in previous decades, the proportion of companies that were profitable when they went public was higher. And so now this bears the question why investors in public equities would go to IPOs or to basically companies to have gone public and buy shares of these companies if these companies are not profitable to begin with. And so this raises the question, and in my personal opinion, I would say that this apparent increased appetite for unprofitable companies by investors may have something to do with the very low interest rate environment that existed over the last decade. Not only in the United States, but also here in Europe. And so this situation, this near zero interest rate environment, have led investors in public equities to search for riskier investments, to search for alternatives to get additional yield. And so they basically bet on the perceived ability of these companies to make a turnaround and become profitable over time. And so by doing that, if this scenario materializes, this would result in very, very attractive returns indeed. And so in light of this, because for sure, private equity funds are always, when they consider an IPO for a particular company in their portfolio, they have also to survey the level of interest in the market. And so for sure, they must have noticed that there was an increased interest by investors in going to IPOs and invest in IPOs. And so I would say that they took this opportunity with full advantage. They took full advantage of this opportunity, and so they were able basically to profitably exit these investments. And so for those who are more familiar with private equity, there are several alternatives for a private equity fund to exit or to sell their stakes in portfolio companies. But the IPO is the most profitable one, happens to be the most profitable one for their limited partners. And so I believe they found a very good opportunity to offload their portfolio of some of these. They have been finding the opportunities to offload some of those companies in their portfolios in a profitable way, even though the companies are not profitable by themselves. And so because of this perceived increased appetite from public equity investors. And so this is a quite interesting insight because it seems that the level of risk tolerance and appetite that investors are having, or at least have been showcasing, it's increased. And sometimes this may give a rise to an increase or a rise to more zombie companies. We don't know. This might be a byproduct of it, but yeah, we'll have to keep monitoring how this develops in the near future. But basically that is all from this video at this point. I believe based on what I could understand from the event itself, there will be further events such as this one or similar to this one in the near future. And of course, I will do my best to within my schedule to attend those and bring their key takeaways again to you guys. As always, leave your comments below. Feel free to like the video and subscribe. As you know, I'm always within reach through to LinkedIn, and if you have any questions, make sure you send me a private message. I'll be sure to get back to you as soon as I can. And yeah, I'll see you all in the next one. Thank you, guys. See you.